right, so our first question that has come in today, as I mentioned, is how to avoid assignment on a debit spread. Well, in general, I wouldn't mind getting assigned on a debit spread, provided that my broker takes care of the other leg for me. And in most cases, the two brokerage houses I use, Options Express and Fidelity, will usually handle that for me, meaning that if I'm assigned early on the short leg of my debit spread, they'll automatically exercise the long to deliver the short, especially if I don't, of course, own stock in that security rather than taking a short position. So let's go ahead and take a look at a bull call debit. Now, right now, I don't have that up as one of my strategies. So let's go to the Other Strategies tab. For the moment, I'm going to take out long strangle. And let's go ahead and add in the bull call debit spread. All right, let's save our configuration. Okay, so let's take a look at a bull call debit. The bull call debit, of course, is a parity trade to a bull put credit spread. What I'm going to do in a bull call debit, in this case, I'm going to sell an at or slightly in the money call option, and then I'm going to buy a deeper in the money call option as well. Now, I'm going to pay a debit to get into the position. The debit will be less than the difference in strike prices, and if the stock stays above both strike prices, in the case of a bull call debit, I'll be assigned on my short option, but I have the right to buy shares of stock at the long option strike, so I'll get the difference in strike prices back and receive my maximum return. The risk is if the stock falls below both strike prices, then both my calls will expire worthless, and I lose the debit that I paid to get into the position. Let's just run a basic search, and what we're going to do is just take one of the results that comes up. Okay, but that's a weekly. I don't want to look at a weekly. I'm going to look at a farther term out one here. So, well, this one's not too bad. Yeah, it is. It's a five. Yeah, it's a smaller one there. Weekly bull call debit. So let's just go to the basic bull call debit screen here. There we go. So out to February expiration, standard expiration. We've got some positions on Macy's. That's a 1-point spread. I was hoping for a 5-point spread. That's okay. I'll tell you what. Let's build one from scratch. Very simple. We'll just go to the custom spread tool here, and let's just use a popular stock. We'll choose Amazon today. I'm not saying that I'm bullish on Amazon by any stretch of the imagination, but let's say today that we are going to enter a bull call debit spread for February, 1 month out. And what I want to do to have a higher probability of being assigned, and we'll go back to this, so remind me of being back to this, but I'm going to go ahead and sell the 590 call and buy the 585. And let's see here, 37.30 to 39. We'll use midpoint prices here for our setup. So that's about 270 there. So we'll call that $1.35 midpoint. So we'll get in at 38.65 on the buy option. Let me scroll down here. So we're going to buy one at 38.65. And at the same time, sorry about that, let's go ahead and sell our 590. So it's about $1.45 bid-ask difference here, so let's go ahead 70 cents or so. We'll put that in at 35.20, 35.25 for our sell option. All right, change that action to sell. Okay, so here's a in-the-money bull call debit spread that I just did wrong. My apologies. Let's buy that at 38.65. Remember, we're buying the lower strike, the 585, and we're going to sell this one. Oh, shoot. What was that price? It was 35.25. I apologize. There we go. 35.25. Okay, so that's our sell at the higher strike. All right. Much better. Now, the goal of this position, I've put out a debit of $3.40 to enter the position. I earn the maximum profit on my bull call debit spread if the stock stays above both strike prices. I'll essentially buy shares of stock at 585 at expiration, sell them at 590, get the $5 back, and have a $1.60 premium. This potential spread would give me, if I got filled at midpoint, would give me a 160 profit off a 340 investment, or roughly a 47.1% yield. Prices are kind of nice because earnings are coming up, and we'll have the ability there to see the inflated premiums. Okay? All right. Now, Robert's question was, how do I avoid assignment on a debit spread? And what I mentioned was that I'd love that. I'd love that, excuse me. If I entered this position today and come Monday, we see Amazon go up to $600 per share, and the other side of the trade, the owner of the 590 call decides to assign it early or sells to close out of it. The market maker decides to exercise my short option. Well, in general, my broker wouldn't just let me, sort of short shares of stock. That's what happened with a short call if we were signed and didn't own the shares. So my broker would probably automatically exercise at 585, and what it would appear is that in an instant I'd buy stock at 585 to deliver at 590. What does that mean? That means I get my maximum profit of the $160 or 47.1% after 1 day in the trade. I want to get assigned on the debit spread. Okay, that's what I want to have happen. And if it happens earlier, that just means I got my return much faster. Okay, Robert, check with your broker if in the case of early assignment on the short call, which we don't control, it could happen at any time if you're in the money, which is where we want to be in a debit spread to have the higher probability. If they don't exercise the long automatically, see if there's a way that you can select or request that they do that in the case of the debit spread position. Okay, I'm sorry, I was just looking at something here. Jim says, do you let a debit spread expire in the money? That's the hope, Jim. That's what I want to have happen. If the debit spread expires in the money, that's where my maximum profit is. Now, true, doesn't matter if Amazon goes to $750, goes to $800 per share, I can only make this $160, okay? But I want it to remain in the money. So do I let it expire in the money? Yes. If I held this position through expiration, let's say it is February 19th, and Amazon is above our 590 strike. Let's say it's at 600 on February 19th. I just leave that alone. And on Saturday, when the Options Clearing Council comes in, most likely, well, I know because I've checked with my broker in this case, but what they'll do is they'll buy shares of stock for me at 585 to cover the obligation at 590, and that's when I get the $5 maximum profit. Could I close early for the maximum profit? Doubtful. I can close early for a profit at any time if both options remain in the money or if the stock gaps up. But we really only get the $5 back maximum, the difference in strike prices, when we're at expiration and all of the time value has decayed out of the option. And then Jim said further, how do you calculate the target price? Well, when I go to open a debit spread, I'm looking for positions that might be slightly in the money, that of course have that maybe 70, really probably a 75% or higher probability of remaining in the money. I want a certain return. This is probably not one I'd look for really. I'd probably want to be deeper in the money so I'd see a lower return. But when I run a debit spread search, I'm going to probably want to be 4 or 5% in the money and want that probability of maybe greater than 75% that my short option would stay in the money at expiration. Probably looking for a leveraged return of at least 10%. Probably only going 20 days or so out in time. It's better to be shorter time frame. You can use the weeklies, of course, in the debit spread position. But once I find my results, I'm going to look at the stock price or the stock chart, and based on the chart then, just like look at any other position, I'm going to determine what is my potential, what do I think the potential is that the stock will remain above this short option strike price at expiration and will remain in the money. Okay. And a follow-up to that was asked is, your stop would be 1% above the short strike? Yeah. When I do a credit spread, this is the exact same profit and loss chart we would see for an out-of-the-money bull put credit spread. And what I look for in that scenario is that if the stock, what do I want to have happen? Again, I want the stock to stay above my short strike price at 590. So in this scenario, one of the rules that I might use to manage my position would be to look to manage the position to avoid further losses if the stock reached within 1 or 1.5% of my short option strike price. So I might look to roll this position, of course, if the stock drops down to, let's say, I don't know, probably wouldn't even use that much. It'd probably be a little bit less than 1%. But if the stock fell down to maybe 592 or 591, I'd probably look to adjust the position, meaning that I'd either want to move the strikes or get out of the position if I have a small profit, because I don't want to turn a winning trade into a loser if it keeps falling and falling, and then I get into the red at that time. There's a webinar. I'll just point this out very quickly. We might even get into it today, depending on what other questions come in. But back on the main webinars page, under the option strategies, there's a presentation here on managing your spread positions, and there we discuss the triggers that we use, Ernie and I use, for managing our credit or debit spreads, and then of course the multiple ways to manage the spread position if one of those triggers is clicked. Okay, but the important thing is, going back again to that profit and loss chart, in a debit spread I want to be assigned. Okay, I want to be face exercise and assignment so I get the maximum return. I can be assigned on the short option at any time because I typically start off with a debit spread in the money, and the short option, of course, when it's in the money, can be assigned at any time. I have no control over that. But if I get assigned early, of course, I just get the maximum return. Assuming, again, that your broker knows to automatically exercise the long option you bought in the debit spread to deliver your obligation of the short. If they don't do that automatically, you want to try to see what they can do there for that. Okay? All right. So if you have any follow-up questions, Robert, on the debit spread, let me know. Of course, if we were looking at the reverse of this, Amazon's at $5.96. Okay, let's say it was a little bit aggressive, maybe too aggressive in the past couple days. And let's say that I thought Amazon was going to move up, and it really didn't. And let's say for our weekly position next week, I had done the sort of parity trade here, but let's say I had entered a bull call debit spread, or I'm sorry, a bull put credit spread for January 29th, where I had sold, let's just call it the 600 put, and bought the 595. Okay, so I entered a bull put credit spread, similar risk reward profile, but I was more aggressive. I was hoping the stock would stay above $600, and this would be a credit spread. So let's say we sold this, I don't know, let's just put this at $30 even, and let's say we bought the 595 for $29.20. Okay, so we had an 80-cent net credit on a $5 risk, or 420 risk. So we're looking at about a 19% return. Now, remember, these are puts. Okay, this is a bull put credit, similar risk reward profile to the bull call debit, but in this case we were aggressive. We thought the stock was going to be above 600, but right now it's between the two strike prices. Now, what happens here when we use the put, of course, if the stock stays above it, both puts expired worthless, and I'd be able to keep that 80-cent net credit. If I hit expiration next week and the stock still, let's just call it 597 even, my 600 put is going to cost $3 to buy to close. And remember, I only took in 80 cents, so we'd be looking at a loss of $2.20 on this position. Now, in the credit spread scenario, I would have entered this trade if the stock, I don't even know if Amazon was, but if the stock was around, $610, $605 per share, that's when I would have sold the 600 and bought the 595, so that both puts were out of the money, and I probably had a good probability the stock would stay above both strikes. Well, now that hasn't happened. It's moved below. Now, how can I avoid assignment here? Because remember, this is the opposite. My short put is in the money. The stock at 596.38, we are $3.62 in the money. So I can be assigned at any time. And what happens when you're assigned on a short put? You essentially have to buy shares of stock at 600. Okay. Now, would I exercise my long at 595 to force someone to buy my shares of stock? Okay, so that would be owning the long put at 595 gives me the right to sell shares of stock at 595. But if the market's asking 596.38, if I was forced to buy shares of stock at 600 because of early assignment, I'd want to turn around and sell them at the market price there. I don't want to you wouldn't be allowed to exercise long because it's still out of the money when it's between the two strike prices. So in this scenario, the question might be asked, well, how do I avoid assignment? And that's what Jim just kind of alluded to, and what I mentioned about that other recorded webinar, is that when you open a position such as this, you want to set triggers for when you look to manage this position. You don't want to let your short put go in the money in a bull put credit spread, or the reverse. If I'm in a bear call, I don't want my short call to go in the money. I don't want my stock to go above it in the case of a bear call. So some of the trigger points you might use to avoid that, as we just mentioned, is that I want to use a stop order if the stock reaches within 1 or 1.5% of my short put strike price. Okay, so again, if I sold the 600, I may have looked to adjust the position when the stock dropped down to 606 or 605. Okay, that's one of the trigger points you might use. If you use delta when opening a position, okay, meaning that You open this spread, your short option that you sold, the short put that you sold, had a delta of, say, less than 0.3 or negative 0.3 when we look at it that way, or 30%, or a delta of 30, excuse me, negative 30. If your delta goes up to maybe 0.4 or 0.5, that's when you might look to manage it. So any criteria that you use to set up this position is what you might use as a trigger point. If you used probability, that I opened this position when the short put had an 80% probability of expiring worthless, then I'd probably have a trigger point that if the probability drops to maybe 70 or 65, that might be a trigger point for me to look to manage the position or adjust it. And of course, you could also use other things such as the range out of the money. If you open the position when the short put was 6% out of the money, but now it's only 3% out of the money, you might use that as a trigger point as well. Or that just falls in the 1% rule kind of as well. You're 1% out of the money. There's other things, of course, other investors might use. In that webinar, we talk about the net credit rule. I don't tend to use that. What that essentially means that if I took in a net credit of 80 and I'm risking 420, I may definitely look to close the position, or trigger point to close the position is if, I reach within 30% of my maximum loss, for example. So if my maximum loss is 140, well, what does that mean? That means I keep the 80 cents from the credit that I took in regardless. So if it costs me 220 to buy this back, at this point, if to close the spread is 220 liquidation value, well, I keep the 80 cents, so I'd have a loss of 140, but it's only 1/3 of the maximum loss I could have taken on the position. Okay, but in general, that would happen if the stock falls, but usually that kind of loss would happen if the stock falls below the short put, which I typically want to avoid. And then going on further into that webinar, we discussed the different ways to manage the position as well. Some of the ones I like to do, some of the ones I don't like to do. A common thought is just, hey, buy to close your short put, sell to close your long put, and just move everything down. So then for March, I'd sell a 590 and buy a 585 and create a new bull put credit spread. Well, your return's going to be much lower because of the loss you realized in the initial spread. You have to go further out in time to recover, but let's think about it logistically. We entered a position where we thought the stock was moving up in price, or was going to stay where it was or move up further, and it moved against us. So why would I want to necessarily do another bullish spread if I was wrong on the trend? Maybe I want to reverse it, close my bull put, and now do a bear call. In either case, just moving the strike prices or doing the reverse spread, if your sentiment has changed, comes with the fact that you could lose both ways. Okay. There's other repairs that are talked about in that webinar as well. And remember, the webinars page there, you can access it directly from your PowerOptions account. But if you're currently not subscribed, or you don't have a current trial to PowerOptions, our public page is poweropt.com/webinars.asp. I'm going to send that link to everyone in the chat window. So you can just go to that page at any time. It's a public page. You do not need to be logged into an account. And you can go through our various webinars on the different PowerOptions tools, options strategies, options concepts, our one from Friday on manage your broken position, exercise versus assignment, weekly options, implied volatility, and so forth. Okay, and then our Friday presentations are usually archived here in that requested topics tab. Okay, so Bill asks, a separate question here, and then I see we have another question on spreads, but Bill is asked, he's a blueprint owner. Bill bought the blueprint from RadioActive Trading. He's had it for a long time. He heard something about revision and updates. How do I know what I have and what I need? Okay, Bill, if you go to radioactivetrading.com, you were at one time given a password for your free registration account to RadioActive Trading. All right, and it's the same password you'd be using for PowerOptions if you have an open trial or subscription. So as a blueprint owner, you can go to radioactivetrading.com and click sign in. Let's just see here if we can do that real quick. All right. All right, so go ahead and click the sign in there. Let's put mine in, and then all right, so go ahead and sign in at radioactivetrading.com. If you don't know your password, let me go back one. I'm sorry. If you don't remember your password, Bill, sorry. Let's just go back into the sign-in view. There we go. Okay, if you forgot your password, you can just get it here by email. So anyway, let's go back to the, let's go back to that. There we go. Log in here. Just want to show you where things are. Okay. All right, so when you log into your free registration account, RadioActive Trading, down here as a Blueprint owner, you'll see that there's Blueprint owner only webinars and latest Blueprint revisions. Okay, and so if you click on that, if you have version 5 or above, you'll be able to see the revisions all the way up to revision number 14 with income method number 12, the combining income methods, income methods 6 and 12, revision 11, the income method number 11 strategy, and so forth. So just log on to your free registration account at radioactivetrading.com, Bill, put in your password, and then you'll be able to see the revisions and updates that are available for you. Okay, if your version is too old, it's older than version 5, it's probably best, we'll give you an offer to pick up a new Blueprint at a discounted price, $300 off. So it'll be $39 to get a full updated Blueprint, but more than likely, you'll just be able to download those PDFs and put them right in your Blueprint there and get all of the information that you need. All right, so Jim has another question. If in a call debit spread, the short strike is out of the money, but the long strike is in the money at expiration, would the broker require me to buy the stock? Potentially, and most likely, yes. Okay, so let's go back there. Let's see if we can go back to our profit and loss chart. This was the bull put. Let's see, can I get back to the bull call debit we had? Perfect. All right, now let's just clear this up here real quick and we'll just talk about it. Let's go ahead and do the same thing with a bull call debit for next week, but we're going to go ahead and enter the 597.50, 592.50, and I'll just use the standard prices, Jim. So for our bull call debit, we're going to sell the 597 and buy the 592. All right, so this is a smaller credit, 9.9%, just by the natural bid prices. Okay, all right. Bill, when you log on, it'll show you. I'm sorry, before I go on, Bill just asked, how do I know what version I have? When you log on, it'll tell you. Okay, I can look it up for you here, but I'm not going to do that during the webinar. I can send you an email later, Bill, but if you just go to RadioActive Trading and log on, it'll tell you exactly what version you have and which updates are available. So you can check that out at any time, okay? All right, so going back here to Jim. So in this case, remember my short call is now out of the money. It expires worthless. If the stock ended at 596.38 next Friday, expiration for our bull call debit spread, 597.5 would expire worthless, and our 592.50 would be worth, let's say, $4. Okay, let's just say it was at 596.50. So it would be $4 in the money. As we get to expiration, be around $4. But in this case, remember, our debit is $4.55. So what are my choices as I get closer to expiration? Well, if I didn't want to own shares of stock, if I hold this through expiration, the stock's at 596, I don't do anything at close, or 596.50, excuse me, then my broker would assume that I likely wanted to exercise this in the money call. And when we exercise a call, what does that mean? It means I'm going to buy 100 shares of Amazon at $592.50. And come Monday, hopefully the stock's still around 596.50 or so. I can sell to close on the open market. I'll get $4 back. What's better to do if you want to avoid the cost of being exercised by your broker, essentially, or having your broker automatically exercise any long calls that are in the money? So Friday at expiration or near expiration, you'd want to sell to close the long. Okay, but here's the problem when you do that, and you can already see it. What is the advantage we talked about of holding to expiration? Well, that's because we get the maximum profit. If I exercise at 592.50 and then assign at 597.50, then okay, I get my 5 points back directly, no ifs, ands, or buts, and we get that profit that we saw. If you close the position early, if you sell to close the long early, you're going to get intrinsic value, of course. You might get a little bit more in intrinsic value, but remember, if I just sell to close this and I haven't adjusted this, even though it's out of the money, I still have a naked call. Now my margin changes completely. Okay, so I'm going to have to put up more money to cover this naked call position in my brokerage account, if you're even allowed to do that, depending on your level of approval. So you'd have to buy to close the short option and sell to close the long, liquidate the spread, because you don't want to leave the short option open, the naked call open on this bull call debit spread. So if you close it before expiration, Now, you're probably still going to have to pay 20 or 30 cents to the market maker to buy to close the short, even though it's out of the money the day of expiration. And you might only get 405, maybe even 410 if you're lucky for the 592.50. This again, assuming the stock is at 596.50. Okay, so we're just trying to do an even 4 points. All right, so the $4 of intrinsic value, but the market maker is going to ask for an additional, you might be able to get an additional 5 or 10 cents for selling at that time, but he's probably going to charge you 20 or 30 cents to buy to close the short call. So now you're at a debit, let's say of 390, where we get back 390. But remember, our debit was 455, so we're still at a loss of minus 65 cents. Okay, but yes, to answer your question directly, Jim, if I did nothing at expiration, our stock Amazon here was at 596.50. Next Friday expiration. I did not close it at that time. I left the 592.50 option open. My broker would assume that meant that I wanted to have it exercised and buy shares of stock. So when you look at your account Monday morning, you'd own 100 shares of Amazon at 592.50. Okay. All right. And yeah, and then Jim says, of course, he likes to scale out of the position with profits to reduce my risk close at expiration. Sure. We're just using an example to keep the math simple of one contract. But most likely, if you're in a credit or debit spread, you might have 10 contracts, 20 contracts, so forth. So as you get closer to expiration of a profit, you might close half of them and then wait to see if you can get more closely to the full profit with the other half, and so on and so forth. Okay, good stuff. All right, so Gary has got a great question here. Very common question. Gary is covered calls. He says, if my goal is CC, and I'm assuming CC means covered call, should I acquire the stock by naked put? Gary, you can. Okay, there's nothing wrong with doing that, but it depends on what your goals are for the position and what you're looking to accomplish. What do I mean by that? Let's take a look at a normal price stock. Let me think of one of mine here, decent one. I'll go Texas Instruments. Not a very volatile stock, not a lot of premiums, but I want to check out the put chain for Texas Instruments. All right, and at the same time, I don't like the way I have this set up here. Let me change this, my columns here. I'll reset to the defaults there. Okay, let's refresh this page. There we go. All right, and I'm going to go out just to standard February expiration at this time, Gary. Let's take a look here. All right, so what we're seeing here is this is a standard call and put chain for Texas Instruments, which is currently at 50.30. Over here, of course, is our strike price. Our calls are over here on the left. Our puts are over here on the right. Now, it didn't show me. Okay, I need to change one quick thing. I apologize there. One quick thing. Choose columns here again, sorry. I gotta take out, yeah, downside protection there. Oh, sorry, folks, it opened on the other screen. I'll show you what I'm doing here. It's in the choose column field. I didn't realize it opened. You guys weren't seeing that. So what I want to do on my put information is I want to take out the downside protection. That doesn't relate to what I'm looking at here as a comparison. And I want to see the percentage naked yield. Okay, that's what's important for me. And let me just change the column order here. I want that to be there. Yeah, and I want the break even to be there. Oops. And the if a sign was put next to the ask. Okay, I'm just going to customize this a little bit. Sorry, folks. And one more. There we go. Okay. Let's get that back to square one. All right. Great. Now let's say you're interested in doing covered calls, Gary, and I'll talk a little bit more about that in just a moment, but we're just taking it into account that we're interested in covered calls. Well, depending on what your goals are for the position, this one's 29 days out in time, or 28 days, excuse me, and I'm probably looking somewhere in this range. And what I mean by that is that for a 28-day trade, I'm probably looking for around a minimum of 2.5 to maybe 3.5%. But I don't want to, sure, this looks great here that I could sell the 52 and have a 5.3% return if assigned. You know, one of the advantages on the PowerOptions chain is that we show you the returns if you enter this as a covered call position, okay? But, you know, I want a reasonable return, but I also want a reasonable expectancy and probability of earning that return. It'd be great if I could get a 5.3% return if assigned in 28 days on Texas Instruments, but that's only if the stock's trading above $52 per share. Right? So that gain, that extra increase, is from the $1.70 that the stock would gain plus the original 92 cents in premium that I received. And of course, you have a lower downside protection. So the good range here is about at the money. Right? So if I sold right now, if we got into Texas Instruments today, if we could still trade, if I bought it today at 50.30, and let's say I just sold the slightly in the money 50 call, we get about $1.80, maybe $1.83, $1.84 at midpoint. We'd have roughly a 3.6% downside protection and a 3.1% return if the stock stayed above 50 to February expiration and my stock was assigned. Okay. Now, could I enter this as a naked put? Sure. If I sold the 50 strike put in this scenario, we'd get about $1.87 bid, $1.94 ask. So let's say we could get about $1.90, $1.91. A little bit higher premium than the covered call. Okay, and of course remember that the call premium here, we're 30 cents in the money. So if we got 183 at midpoint for the call, minus the 50 cents intrinsic, our time value that we're collecting is really only $1.33. This at the money, slightly out of the money put, if we got filled at the midpoint at 190, okay, and let me jot that down too. Texas Instruments here, the 50 strike call and 50 put, and we're going to call that 183, I'm sorry, and 190. Fantastic. Okay. But you see here the 50 strike put at 190 is giving us a better naked yield. We'd have to put up $50 or $5,000 per contract to cover the obligation of our naked put, but we're getting 3.7% against it, and the stock can fall 4.3% before we start losing money on the position. So in this scenario, I'd say the return is better. But that is a broad assumption on my part, isn't it? I'm assuming that you're interested in trading the at-the-money covered call versus selling the at-the-money put. So if it drops a little bit below 50, you get assigned the stock. Your cost basis would be closer, of course, to $48.10 because that 190 premium would reduce it by that much. Okay, but you might approach it a different way. The way you mentioned this, Gary, you said that you were interested in covered calls, and should you use naked puts to get into the position? Well, it's an interesting concept there because it sounds like you're interested in covered calls, but you're not really interested in assignment, meaning that the way that question is phrased, it sounds like you want to be in the stock long term. So if you get into the stock or you put the stock, it sounds like you're thinking about selling out of the money calls with the lower premium and the lower downside protection because you're married or you're linked to a certain number of stocks and you just want to try to generate income on a regular basis, but you're hoping not to get assigned. Why do I make that assumption? Well, it's because if you were thinking of trying to get in at a lower price and then hopefully getting assigned there and then selling calls against it month by month, you would probably just buy the stock right now and do the covered call and start selling the out of the money calls, okay? Because remember, what you're trying to do in that scenario is if your long-term plan is to own a stock for several months that you feel bullish on over a 2 to 3 month cycle and sell calls against it on a regular basis, but you're not looking to be assigned on that position, if you're using a naked put, what you're really saying to yourself is, I'm going to look for a stock that I feel has the potential to drop a little bit, maybe only 1, 2, or 3% in the first month, so I get assigned to get the lower cost basis, but then I expect to be bullish the next 5 or 6 months after that. If you can do that on a consistent basis, you don't really need my help. I mean, that's a hard thing to do. That's really timing your trade. You're looking for a stock where you're going to sell a put to generate premium. That's all well and good. It's a good strategy if you can pick the right stocks and you practice proper management. And you can get in at a cheaper cost. But in order to get in the cheaper cost, the stock has to fall below your strike price. And then you turn around and you want to do covered calls on that position. That's good too. But at the same time, the profit that you make from covered calls long term, if you're selling out of the money and hoping not to get assigned, just means that you're again saying that I want a stock that's going to fall 1 or 2 points in the next 20 to 30 days, and then after that is going to consistently move up 1 or 2 points every 3 to 4 months after that. Okay, it's a tough way to time trades. Now, let's take a look at a profit and loss chart. And Gary made a comment. He's like, I'd like to get a lower price. Okay, and a naked put is a great way to get a lower price on the stock. But keep in mind the other thing. Whether your long-term goal is covered calls, your long-term goal is premium generation on a weekly or monthly basis, the covered calls and naked puts are exactly the same trade. They are parity trades of one another, okay? And the reason why I say that is, again, let's just, you know why. Let's take a look at our position again. If I got into Texas Instruments today, let's say we did buy 100 shares at that $50.30 price, and at the same time I sold that February 19th 50 call. That's what we were looking at, and we were going to use a midpoint of 183. All right. So now, of course, we see our maximum return is $153, which is earned if the stock stays above $50 per share. In theory, that's going to, well, not in theory, but that's a 3.2% return. Okay, so we got about a 3% time value, that $1.33 again that we generated against the position. Now, we took in $1.83, okay, which means essentially that we've lowered our cost basis in this position down to 58.47, or 48.47, I'm sorry folks, 48.47, which in essence is our maximum risk. Is it possible that Texas Instruments could go to zero and go bankrupt? It's possible. Is it likely? No, but it is possible. So remember, in a covered call, you're essentially risking 100% of what you invested, although that's never really going to happen, but it has happened in the past to some investors, unfortunately. But if earnings season now, we're in the earnings season bubble, and I think this is 12 days away or 11 days away for earnings in Texas Instrument. If I'm in this covered call for February, earnings comes out, and the stock has a sudden 33% gain, even if I'm using a stop order, I get closed out of the position, I realize a loss of 33%. If on average I'm only making 2.5 to 3% on my covered call positions, that's over 10 months to get back to break even from this one loss, assuming everything else goes well, which it never really will in this type of strategy. Okay, it's hard to be profitable long-term in your portfolio in covered call investing. Okay, and think about it. The reason why is that if you pick the right stock and it goes up to 60, or even if it goes up to 55, 57, or $58 per share, you make 3.2%. Okay, that's great. But in all the positions that fall, 5, 10, 15, 20%, and you will have some in your portfolio, regardless of the time frame, those get stuck in your account and you're forced to manage them. So if I have 10 positions and I make 3% yield on all 10, that would be a 30% profit. And if one of those positions has the unexpected happen and it drops 33% during that time frame, just one of the 10, that means I was right 90% of the time and still came out of the month with a loss. Okay. Now, a lot of people say, well, you don't care about the underlying stock dropping in value because you can just roll down the calls and continue to generate premium. Now, I absolutely care. If I see my portfolio is down 3%, but I had 90% successful trades, that's telling me that this is not working long term. Right? And that's not going to happen every month, but you will always have positions, covered calls, naked puts. Even if you're trading collars or credit spreads or debit spreads, you're going to come across a position where the underlying security drops 20, 25, 30% from an unexpected event in the pre or after market hours when you can do nothing about it. It's just inevitable. It's just the way the market works. Okay, so would it be better in this case? Here we are at a 3.2% return if the stock stays above 50 in the next 29 days. Would it be better to try to get in at a cheaper price, go to February 19, and sell the 50 strike put? And again, we talked about that premium of $1.90 for our naked put position, cash secured naked put. All right, so what does this mean? Well, we take in $1.90 right away. Our broker's likely going to require us to put up $5,000 to cover the obligation for buying the shares of stock if it falls below 50. You might be using margin at your broker. Just be careful with that, of course, because it works both ways. But see, this here is a 4% yield. Hold on one second. Apologize, folks. This is a 4% yield. I can't give any direct trading advice, and I'm not even saying that I would do this on Texas Instruments. But in this case, to me, this is a better risk-reward ratio. Sort of my cost basis, if I put the stock as 48.10, remember on the other position we saw it at 48.47, essentially the out-of-pocket cost for the covered call. And I'm taking a yield of 4% as opposed to the 3.2% with the same at-the-money covered call. And in this case, I'm hoping, I guess, and it's hard to gauge. I mean, in this case, I'm kind of hoping that the stock maybe falls down to maybe just a little bit below 50, maybe at $49.50 or $49 per share. I want it to be above 48.10 essentially. And so now I get put the stock at 50, but my cost is 48.10. So maybe now I sell a 49 call for the next month out, or another 50 call, give it some room to maybe grow up in price and get a little appreciation as well. So long story short, what's the answer? Well, there's no real answer, Gary. It comes down to you, okay? And what you want to analyze is, if you think the stock is going to stay the same or move up, what is the comparison of the value of return, okay, the naked yield for the same strike you would sell in the covered call versus the same naked put you would sell, or the at-the-money naked put, which one is giving you the better premium? Now, why is this giving us a better premium? Why is the out-of-the-money put giving us a better premium than in-the-money covered call? It's probably likely because puts are inflated right now due to fear in the market and the fact that earnings season is coming up. Okay, that might have a little bit something to do with it there. So the out-of-the-money put is at 190, and the slightly in-the-money call that has intrinsic value was only at 183. You know, so in this case, the put, I think, would be a better trade. In either case, you should only do a covered call. Naturally, I mean, it sounds simple, but you'd be surprised how often I have to reiterate this to investors. You'd only do a covered call or a naked put on a stock that you would not mind owning long-term in your personal account. I tell my customers I don't want you to go into the naked put search and start screening for positions that are 15, 20, 30 days out in time for cash secured naked puts where you're looking at a naked yield of 5, 6, or 7%. They exist, but that's outside of the norm. That position is inflated premium due to higher implied volatility. You say, well, that's what I want. No, it's really not. It's inflated for a reason, because some event's coming up or something's been going on with that stock where it has more of a likelihood of going against you and causing larger losses, okay? So whenever you do a covered call or a naked put, it's preferred that you should only do those on positions that you would not mind owning in your account long term, okay? So we want to compare the returns that are available, and then also, most important thing that we always tend to forget in any strategy that we're doing, what are your expectations, okay? We talked about this naked put sell. What happens if the stock goes up to 55? Okay, well, our put expires worthless. We are not in the stock position. We keep the $1.90. And so now we can say, okay, well, let me now sell a 53 strike put or maybe a 55 strike put to try to get in at a lower price. Or I can continue to sell the 50s, but remember, if at February the stock's trading at 55, these 50 puts, the deeper out-of-the-money puts now are probably only going to be a premium of 20 to 30 cents. They're not going to be worth much at all, you know, rolling out to the March series even, okay, because they're so far out of the money. So in order to keep continuing to get this 2%, 3%, 4% yield, you're going to have to be right at the new at-the-money level. And if the stock continues to move up, okay, it expires worthless, you still don't own the stock. Trade-off on this one, something that's interesting, and this is where I was going earlier, but let me stay where I was. I'm sorry, I don't want to bounce around too much. The expectations is the key. Which position will give you the better return if your expectations are that this stock might be trading at $52, $53, or $54 per share in the next 30 days? It's probably going to be an out-of-the-money covered call, buying the stock today at $50.30 and maybe selling a 52 or 53 call for a cheap price, and then if the stock moves up and you get assigned, okay, then that would be the better return. All right, the at-the-money was giving a good yield of 3.2%. But again, hindsight 2020, if my expectation is the stock's going to be at 52, 53, or 54, you could make money on the covered call. You could make money on the cash secured naked put, but you'd be better off with a different strategy. Maybe a married put that leaves the upside open, a long call position as long as you practice discipline so that you can actually take advantage of further upside if the stock continues to grow instead of capping your gain on these positions. Okay, that's the trade-off. So, you know, you're probably comfortable looking, as we mentioned, Gary, for those 2-3% returns, and that's why you're interested in the naked put and the covered call, and that's a possibility. Okay. Oh, well, okay, a couple of comments come in. Jim said, selling options is preferred over buying options when implied volatility exceeds historical volatility. Yeah, it's preferred because it's a higher premium. That doesn't mean it's the best time to sell, because remember, when you sell, you're obligated to do something. And if you're in a volatile market where stocks are swinging back and forth, you may suffer run the risk of suffering large losses to the downside, and of course, minimizing your gain to the upside because of the capped level. Okay, and yes, Gary, the reason because of the implied volatility and why the puts are more expensive right now than the calls is because of the volatility in the market, and we're entering earnings season. Now, this is a specific example, but the other key here that I wanted to address, we talked about, comparing the covered call versus the naked put. What works for you, Gary? What matches your risk-reward tolerance? That is a question I cannot answer. A handful to a dozen to 2 dozen people on the line here with us have heard me in other webinars and know that I don't trade covered calls anymore. I rarely trade naked puts, but I do occasionally. And the reason why is because of this risk-reward ratio. Okay, I prefer to trade standard collars if I have a good premium where I know I have a locked-in loss that even if the stock drops 10, 15, or 20%, guaranteed not to lose more than 3 or 4% on my position, and I can still make a 2 or 3% to the upside as well. Or a married put position where I have guaranteed protection out long term. My maximum risk in the absolute worst case scenario is only 5 or 6%, but I have an unlimited upside instead of a capped upside. But I do that on stocks that I'm long-term bullish. Texas Instruments happens to be a stock that I'm in right now with the married put position. Okay, but going back to a covered call or naked put on Texas Instruments, and remember we're talking about the February series, there's 2 things I have to take into consideration. Okay, and let's just go into the stock research tool. Number 1, earnings is coming out after market on January 27th. Okay, is that a good thing or a bad thing? I don't know. I honestly don't know. I'm hoping it's a good thing because, again, I'm in this position as a married put, but at the same time, I don't know what the earnings are going to be. In a covered call position, if the earnings disappoint, and even a stock like Texas Instruments, we can see drop 20 or 30%, even if you're trading a covered call with a 7% stop loss, if the stock falls, the stock gets violated, and you get closed out at that 25 or 33% loss. Whatever the market offers, that's where your broker will close you once the stock breaches through in the pre or after market hours. Okay, and if the stock gaps up to 55 or 58 back where it was a month and a half ago for positive earnings, you missed that upside. But the other thing you'd want to consider, Gary, is this here, and it hasn't updated officially yet, but we know it's going to be around this time. The last dividend date, ex-dividend date on Texas Instruments was 10/28. Implies the next one's going to be around 1/28, 1/29, shortly after the earnings. That's great. Okay, why is that important? Well, in the covered call, if I have the 50 strike and the stock's at 50.30 and I hit the ex-dividend date, I might get assigned early. Now, that might be okay if that was my goal all along. Okay, but if I'm using this again as we talked as a position where I just want to have a stock that I feel I'm bullish on long term, and I'm looking to just sell out of the money covered call premium month by month by month, okay, to just generate a strong premium, lower the cost basis. If I'm coming up to the ex-dividend date, if my stock pays a dividend, I'm coming up to the ex-dividend date, and I'm slightly in the money or even at the money, I'm probably going to want to roll this call to a higher strike to avoid early assignment. All right, because if I'm slightly in the money on the ex-dividend date, I'll probably get assigned. The person who owned the call will likely want to own the shares of stock to take advantage of the dividend, and I'll get assigned on the position. But earnings is the trick. I don't want to be in a covered call or a naked put with earnings coming up, no matter how positive I am. As I mentioned, what I would probably do in this is our naked put, of course, but if I was going to open this position today, which I'm not, let's call it 50/30, go out to February here, take advantage of the dividend, I'm probably selling slightly out of the money. Yeah, I'll call it a 51 call. It's a nice premium there, 131 to 139. And then I'm probably buying, I got to go to the 46 put, nice 5-point difference. I'd like to go to 45, but I think the 6 points is too much. So what I'm going to do, I'm still going to sell a call. It gives me some premium up front. I'm going to use some of that premium to buy a put option to fence in the position. This is not the risk reward that I want. Okay, what I typically look for in my standard collar positions is, yeah, this is the return I want. I want that to be at least about 2.5 for a 20 or 30-day trade, but I don't want my risk to be greater than about 5% or so, or maybe even 5.5 at the most. The reason why was that with this win-loss ratio here, making 2.5 when I'm right, but knowing I can't lose more than 5.5% when I'm wrong, when I have this set up, I know that I can be right only about 63% of the time and still make a profit long term. Okay, my married put portfolio is much better. I mean, my average wins are about 7% because I don't cap the upside. My average losses are about 4%. With that ratio, I can actually be wrong more often than I'm right and still make money long term. But thankfully, I'm still at around the 67, 70% right ratio, so that's a good portfolio. My collars, I'm about the same, about 66% right, but because of the limited upside here on the collar trades, I perform better on the married put plays than I do on my standard collars. But I still like standard collars. I've been trading them for about 12 years. I've been trading married puts for about 6 years. Okay, all right. Yeah, Jim just says Texas Instruments goes up after earnings 8 to 9 times in January. 8 out of 9 times. Yeah, you know my luck, Jim. This is probably going to be the 1 out of 9 times it doesn't the way this market's been, but we'll see. I'm almost bulletproof on that position. Let's see here. I'll go back to RadioActiveTrading.com. I could have made adjustments earlier, but yeah, I only have a maximum risk on Texas Instruments, I'm sorry, of 0.3%. The put's all the way out, I think, to March. Oh, it's April. I'm sorry. I have an April 60 put that's now deep in the money, of course, but I'm only at a risk of 0.3%. I still have unlimited upside. Regardless of what the earnings do after the next dividend, this will be bulletproof, and then I'll probably do some other income methods after that. I'll probably do another income method before earnings as well on Texas Instruments, as well as Seagate and a couple others. Okay, Juan, that's a good question. What do you do if your stock goes down significantly? Married put way up, of course, but still a few bucks under amount invested. Okay, so I'm sorry, I didn't understand that second part there. What do you do if your stock goes down significantly the married put way, but still a few bucks under the amount invested? Which income method would you use to have some gain? Okay, well, the married put is still a bullish strategy. One of the examples I'm in right now, I don't know if I have it in my portfolio here on our test account. Sorry, folks, let me take a look here. I don't think I put Seagate in here. Oh, I do. Okay. Here's a good example of one that just completely got away from me. Had I used income method number 12 a month ago, it'd be fantastic, but I didn't. Here's Seagate. I bought the stock at 51.68, have a 55 put at 7.50. The stock is trading at 27.93. It's down about 50% from where I got into it. I'm at the max loss of about 7%. Actually, from some dividends and some other income methods, the max loss is only about 6% here on this position. But I mean, there's nothing I could really do on this, to tell you the truth. I could adjust the put, but that would increase my risk drastically. Okay, I don't want to do that. I could do an income method number 5 before earnings, which I might do. But anytime you do anything with selling a call now in this type of structure, where the call is below the put strike price, you know, someone says, cool, you could generate income by just selling a call. All right, let me go with the out of the money 29 call for February, about 112 premium. So I bought the stock at 51.68. I have the 55 put that's worth close to $30 right now, $24 right now, but I bought it at 7.50. And I have the February 29 call. Let's say I sell that now. Notice how my risk goes up to 50% in the upside, in the direction that I thought the stock might go originally. See, that's the problem. Of course, I'd only lose 5% now instead of that 7% that we just saw. But see, if the stock gaps up to earnings, it goes back up to 34 or 35. I'm looking at a very significant loss on my position. Because remember, my cost basis is still 58.06, stock plus the put. And as the stock gap, if the stock gaps back up, I'm now obligated to deliver shares of stock at 29, and the 55 put is losing value from where it is right now. I'm not getting any delta advantage anymore because of the short call. Selling the short call is actually trading against myself, not buying the put. You know, think about it this way. If I bought the put in this scenario and over the last 4 months just sold calls against it, well, the stock's down close to about 50%. I would have only generated 12% or so with covered call premiums, okay? And we're down about 50 cents, so I'd be at a 38% loss on this stock. Okay, it's just a free fall straight down. But with the married put, of course, right now I'm only losing about 6%. So that's night and day, you know. But the minute you sell a call, say, oh, I got to generate premium, so let me sell a call right away and below the put strike price, that's when you're trading against yourself. Okay, the call does much more damage than you think it does. Yes, you take a premium up front, but it actually does more damage to your overall position. Okay, that doesn't answer your question directly. I just bring that up as a point, Juan, because I want to reinforce that you don't want to sell a call below your put strike price necessarily. Okay, but let's take another look here. Your Your stock goes down significantly, but it's still a few bucks under the amount invested. Okay, so you probably have a position similar to what I'm in Kroger, or similar to what I'm in maybe even Texas Instruments, but I think Kroger's closer. Let's go back to the portfolio here. This was a presentation we did on Wednesday, was manage your broken stock. Okay, and we used examples here for Kroger on January 20th when it was trading at 42.31. Oh, there it is, 42.31. The stock's now at 37. It's down about 5 points, or 12.3%. Okay, and that was on December 30th. Was when we put it in. So what I want to do real quick, I'm going to use the historical chain here. We can go back a month or two on the chain. And I thought I'd put this in during the webinar, but I guess I didn't. But on January 30th, sorry folks, December 30th, let's take a look at where Kroger was. Of course, we were at 42.31. Expiration dates, let's go to July. April's close, isn't it? Let's go to July, though. And down in July, the 45 put would have been 430. Okay. The 45 put, and the stock was at 42.31. Let me just put that in real quick. This might be closer to your position. We'll run some examples. So, back in time, 12:30, we entered a married put on Kroger. This is not my numbers. I was actually in Kroger, I think, before this time period, slightly. I want the July 45, same date, and we're going to put it in at 4:30. Okay. All right, so 2 married puts now. Kroger, let's take a look at this put position. So on the married put, the stock is down 12%. We're probably close to that 3.5% loss. Remember, if we had traded this as a covered call in December, got 2 or 3%, let's say, for the January covered call, and then maybe rolled to February, we'd be at a 6% loss, where the married put right now we're looking at 3.5% loss. Now, 42.31 original cost basis, but plus the put, we have $4,661 invested in the position. At this time, the stock is now trading at 37.12, so we could say that it's roughly $9 below our invested price, but $5 below our original investment into the stock itself. Okay, so what are some of the things we can do now? Could I sell a 40 call? Well, you could, but we know what that's going to do, don't we? Let's go out to February. The Kroger does not offer weekly options. Well, can't sell the 40 anyway. It's only worth about 10 cents. It's not worth it regardless. So how about the 37.50? About 85-cent premium. Okay, let's take a look. And remember, we do have earnings coming up on this one as well. Now, why do I mention that? Well, because now my risk goes up to 18%. Not to the downside, to the upside in the direction I originally thought the stock was going to go. If the stock falls and stays below 37.50 or continues to fall, sure, I'm only losing about 0.6% on my position as opposed to 3.5 right now. That might be okay. But at the same time, if I think it's going to recover, I can get significant losses if it jumps back up to $41 or $42 per share. We're looking at a loss of $200, $232, which is well more than that original risk we took on the position to the downside. All right, so selling that call, does it generate premium? Yes. And you say, oh, well, if it starts to move above 37.50, just roll it. How weird has this market been? I mean, some days where I see these stocks up $1 or $1.50 would put us at 38.60. We're already in a significant loss in the position. Okay, and with earnings coming up, this could be gap back up to $41, $42 per share, depending on how the earnings play out. Then I'd be in real trouble. Okay, again, it's the short call that's causing this problem, not the put. It's the short call that's causing the problem. All right, so that's not something we'd want to do. Could I be better off adjusting the position in a different way? Yes, one of the ways in the blueprint tells us that we can lower our total cost in the position by maneuvering the put down, and I could even maneuver down and closer in price. Okay, and at the same time, that would put me in a position where I could, move it down and closer in time as well. And at the same time, I might be able to be in a better position to generate other income because of the put I selected. Now, what do I mean by that? Well, let's take a look. Naturally, the stock has dropped, so original premium of 430 we could probably sell the 45 put now for $8.45. Okay, so we're going to generate close to $4.15 in profit from the put. This doesn't look too bad now, does it? If I sell to close the put, my cost basis is $38.16 on the stock after taking into account the profit from the put, and stock's at $37.12. So I'm only losing $1 now on that position. Okay, well, I could maybe manipulate this and go closer in, and even though, yes, I did spend some money on the position, what if I bought now a March 40 put, $3.50? It's going to increase my risk. I know that, but at the same time, I now have a 40 put instead of the higher cost base. My cost basis now is only $41.66. My risk is only 4%. So you took advantage of the monetary gain on the original put you had, and then which has both intrinsic value and time value. Okay, not a lot of time value, right? The stock's at $37.12. Your 45 put is $8 in the money and 12 cents. I'm sorry, it's wow, $7.88. So you've got about 60 some odd cents of time value on that put. All right, but you take that, use the profit to buy a cheaper put, but at a lower strike. So you're not guaranteed to get 45 back, you're only guaranteed to get 40 back. And so now we have a risk of 4%, which is higher than the 3.5. But now that you have the 40 put, things might look more attractive. Well, let me clean this up a little bit. And what I mean by that is that we saw originally, let me just do this. If I sold to close my initial put, cost basis of $38.16. Okay, so let's do that. Okay, now let's do that same thing. Let's buy that March 40 put at $3.50. Okay, so this would be the new position, that 4% at risk. Now, there's that riskless spread trade that Kurt likes. Maybe I could sell the 37.5 call, but at the same time buy a 40. Now that I have that lower strike, I'm not holding the 45 with a $46 cost basis. I'm holding the 40 with a $41 cost basis. So now I might try a riskless spread trade here. Income method number 5, of course, is not a choice. I don't see any combinations there where that would work. Thus, neither 11 would work. But let me go ahead and do that. Nah, doesn't look what I wanted to. See, if this was an upper peak and it just went a little bit lower, that'd be okay. But this isn't what we want to see. And of course, I don't think you'd still want to do this either. Yeah, that's a little bit better. I mean, it's a 1.3% loss, but you take the risk too high. Okay, so my suggestion to you, one, would be to evaluate, especially, I do this only. This adjustment we're looking at here, I'm going to do only if I feel the stock's going to recover over time. Okay, if I don't feel the stock's going to recover, well, another choice is if you think the stock's going to continue down, you could look into income method number 12. You could consider an alternative, which would be just, if you think the stock's going to continue to fall, what's hurting you? Well, the stock has a delta of 1. You're losing 1 to 1 for every dollar the stock drops, and you're probably only gaining 60, 70, 80 cents on the put. So if you still have a sentiment that the stock's going to continue to fall in price, sell to close the stock and leave the put open. You just have a long put position now. Yes, you have a loss on the stock, but that intrinsic loss you have on the stock is likely already covered by the gain you have in the put. Okay, so on paper and in your account, it's going to look like you lost a fair amount of money on the stock, but you also have that gain on the put as well to counter it. Okay, and then that's if you think it's still going to continue down in price over time. That's what you'd want to look at. All right, so those are some of the things. When the stock falls below your initial price, remember our original position there was at 42.31 with the put purchased for, oh, that's the covered call, I'm sorry. That's the covered call on Kroger that's down in price. Sorry, folks. Let's start from scratch again. There we go. All right, so when the stock has fallen below your cost basis, you have gain in the put. All right, that's what you want to manipulate, is the gain that you have in the security that went in your direction. All right, now if the stock's up, we still can manipulate the put or do other things with the calls. But just selling a call right now to generate income or trying to do one of the elaborate spreads, with the stock falling, most likely you won't see a good opportunity for income method number 5. And if you don't see a 5, you likely won't be able to see, you won't see an 11. I'll say that outright. You won't see an 11 following the rules in the blueprint. If you think the stock's going to continue to fall, that leads back to what we were talking about earlier in this presentation, the importance of expectation. Don't do a management technique just because a management technique is there. Whether we're talking about radioactive trading, credit spreads, debit spreads, rolling a covered call, make sure that the adjustment you're evaluating matches your sentiment for the stock going forward. It might not be your original sentiment that you had when you opened the position, okay? My sentiment might have changed slightly. But whatever adjustment I have to do, I have to make sure that graphically it matches what I'm willing to risk if the stock recovers or what I'm willing to risk if the stock continues down. And it has to match my expectations. If I think the stock's going to continue to fall, I want to put myself into a position or convert this to a position that profits as the stock falls. If I think the stock's going to recover and move back up in price, I might want to roll down and lower my cost basis. So if it does come back to $42 or $43 per share, I'll probably be at a profit at that new adjusted position where I wouldn't be right now in the same if I left the position alone. All right, so that's what you want to evaluate. What's going forward? Take a look at income method number 9. Take a look at income method number 12, and if you want some further assistance with what opportunities you might use or how would you use 12 on your position or 9 on your position, go ahead and send Kurt an email. Right? Just send Kurt an email to support@radioactivetrading.com and let him know that you're considering maybe a 9 or a 12 and what your specifics are for the position, meaning what was your cost basis for the stock, what is your current put, if you've used income methods already, what is your new adjusted cost basis for the stock or for the total trade, and then what are your expectations going forward. And if you don't know, that's fine. Okay, and Kurt might put together for you 1 or 2 ideas showing an example of 12 or of 9 and when you would use it, why you would use it, and how it's going to benefit you as well. So that's what I'd look for to do. Now, let's go back to here, radioactive trading. We already talked about this position on Texas Instruments, but I'm down on a lot. This one here is small adjusted risk on AGO. I actually increased the put time period a month or so ago. I had the risk down to 2.3%, but I increased it. My 27 call just expired worthless last month, but the stock's already dropped down to 23.76. Why haven't I done an adjustment yet? Because I don't like to panic adjust. When the stock fell to 26 and then to 25 and then started inching a little bit below 25, I figured it was going to come back. Well, then it went down to 24 and 23.76. Like I said, it's been a tough 2.5 weeks at the start of January, almost 3 weeks now, really, to the start of January. So it fell much further than I thought. Sure, I could have, if I had done income method number 12, or if I had sold the stock and left the put open right after my call expired, or even before then, in that scenario, if I'd used income method number 12 at the beginning of the month, this position would have a profit of about 8%. Okay, I'm still at a loss of only about 4% now, 3.2%, but I know going forward I'm going to be able to adjust that position. Earnings are coming up. I'm going to receive another dividend, which is going to cut this down about 1.5% as well. Seagate's, way below. We saw that. IDTI is, Boyd Gaming is the one I was thinking of. Yeah, that's the bulletproof one, of course, that's just a little bit below my original cost basis, but we're holding a 20 put. And then we just looked at Kroger as well. That's at 37.20. Oh, yeah, I'm sorry. IDTI is at 24.50. I think I'm holding the 27 put. Oh, it's the 30. It is the May 30. I haven't done any adjustments on it yet, but earnings are coming up, and I'll probably do a 5 and some other combination with that as well. But I just bring that up one because, yeah, I didn't do income method number 12. No one has a crystal ball. So if I had done income method number 12 at the beginning of January, all of my positions would be at a profit of around 8 or 9% right now. I could liquidate all of them for a gain around 8 or 9%, maybe a little bit more in some cases. Yeah, especially the bulletproof one. Boyd Gaming would be at around 15% return right now. However, hindsight's 20/20. The drop was much beyond my expectations going forward as far as a bearish decline. So, I'm not going to cry over spilled milk. What I'm really waiting for, though, on is to see how the earnings react and see what the premiums I can get for certain things, a 5 or perhaps a 6 within a couple weeks or 1 week of earnings. I haven't seen anything on Seagate yet that I like, but I'm looking for that because I'm hoping for a bounce. But I'm also going to position myself where I might do combinations 5 and 12 and 6 and 12. So if the stock falls, I might be in a position to make a profit because of poor earnings. If the stock gaps up, that losing position might be turned into a profitable position because of the income method number 5 or the income method number 6. Okay, so review your stuff in the blueprint there. take a look at them, and then don't feel shy. As a Blueprint owner, Fusion member, of course, you can send any of your questions to us at support@radioactivetrading.com. I usually leave the email alone. If you address it to Kurt, I'll leave it alone for the first 12 hours or so, but if I see that Kurt's been busy and he hasn't gotten back to you, then I'll tell you my thoughts on it as well once I see the specifics of the position. All right, ladies and gentlemen, I don't see any other questions coming in right now. If you do have any last-minute questions, go ahead and send those in. It is 5:45 p.m. Eastern Time. My window here in the basement is dark, so I can't tell if it started snowing here in Delaware yet, but I'm pretty sure it has by now. All right, and for those of you who are joining us that got the invitation and you're not currently taking a trial, just remember at any time you can go to PowerOp.com and just put in first name, last name, and email address, and we'll give you full use of the tools for 14 days. Don't need any credit card information. After the trial, our 20-minute delayed service, which gives you access to the search tools we saw today, plus the portfolio tools we saw, the profit and loss charts, plus a whole lot more, with 20-minute delayed quotes is only $60 per month. We do, of course, offer a real-time service, which is $100 per month. So every time you refresh a page, run a search, or refresh your portfolio, you're looking at the numbers and calculations at that very instant. And we did feature some of the back testing tools, just the option chain, but there's also a historical search and historical search by symbol. And the upgrade from the 20-minute delayed to historical or real-time to historical is just $40 extra. So 20-minute delayed and historical is $100 a month, and real-time plus historical is sorry folks, is $140 per month as well. Okay, so let's see here. Yeah, if you do have think of any questions later on, just go ahead and contact us at any time. You can send us an email to support@powerop.com. You can also call us during market hours, 302-992-7971. Of course, there's contact links in the bottom of every Power Options page as well. Next week, I believe Kurt's hosting a presentation on Tuesday. We'll have Power Options presentations on Wednesday and on Friday again at 4:30 p.m. Eastern Time for open discussion. So I hope to see you all at one of our live presentations. Well, take care, everyone. I don't see any other questions that came in. You have a fantastic weekend, and we'll see you next week. Good night, everyone.